So you've probably seen gold and other precious metals, making headlines as their prices climb and
Yeah.
for this deep dive.
They many.
Yeah, we're going to kind of peel back the layers here a bit and go beyond these simple explanations to really understand what's driving this gold surge.
Yeah, and we're going to be focusing on this May 2024 GBD. Why has the gold price broken out? .pdf report,
Right, exactly.
which has some really fascinating perspectives on this whole thing.
Our goal isn't just to tell you, hey, this is what's happening,
Right.
but really give you that deeper historical and economic context to help you understand how this all connects.
Yeah, and the author of this report starts out bullish on precious metals, which is, probably not too surprising, given the title of the report.
Right.
But one of the things that he points out is that there's not a lot of public enthusiasm yet, which he thinks is actually a good sign.
Right. It's not like everyone's, suddenly talking about gold like it's the next big thing.
Yeah.
To really grasp the long-term context, we need to go back almost a century to the United States Gold Reserve Act of 1934.
Okay.
This really laid the groundwork for a lot of the dynamics we're seeing today.
Yeah, the Gold Reserve Act of 1934 was really a pretty transformative piece of legislation.
Yeah.
It essentially mandated that the Federal Reserve had to surrender all of its gold to the U.S. Treasury. And probably more significantly for the long run, it prohibited both the Treasury and financial institutions from redeeming dollars for physical gold.
Wow.
So that link was severed.
Yeah.
The act also established what's called the Exchange Stabilization Fund within the Treasury. So this is kind of a tool that the government could use to manage the dollar's value without needing the Fed's approval.
Interesting.
And then crucially, it gave the president the power to set the official value of gold.
So it's just kind of like giving all this power to the president to just determine what the price of gold is. To understand the atmosphere at the time, it's worth remembering Executive Order 6102 from the year before in 1933, which actually made it a crime for U.S. citizens to own gold.
Wow.
So you really see how this legislation
Yeah.
kind of sets the stage for what's happening next.
It's really concentrating gold in the hands of the government.
Right. And with that power that the president had been given through the Gold Reserve Act, President Roosevelt changed the official price of gold from $20.67 per troy ounce to $35.
Yeah.
A pretty big jump overnight.
Huge jump.
And the author of our source material, he views this quite strongly, calling it a show of disrespect to the American people.
Yeah, so there were some pretty immediate impacts from this revaluation. It essentially created an incentive for gold miners around the world to produce more gold.
Okay.
And it incentivized other countries holding gold to send it to the U.S.
Because they could get more dollars for it.
They could get a higher price.
Yeah.
Yeah, because remember, the dollar price of gold went up, so that means the value of the dollar went down.
Right.
So this is inflationary.
Yeah, so you really start to see how this one act is setting off this chain of events. And it also creates this huge inflow of gold into the U.S. Treasury.
Right, a lot of which, of course, ends up in Fort Knox.
Right.
And so this dramatically expands the U.S. money supply.
Yeah.
And pushes real interest rates lower.
Real interest rates, just to clarify for folks, are what you get when you subtract the inflation rate from the nominal interest rate. So it's really that purchasing power of money that's being impacted.
And the author also points out that this devaluation coincided with a big jump in GDP growth, averaging over 8% per year between 1933 and 1941.
Wow.
And economists Milton Friedman and Anna Schwartz actually argued that this was driven by the rapid expansion of the money supply that happened at the same time.
So you're seeing this economic growth, but it's fueled by this influx of gold and this kind of artificial change in the price.
And capital flight into the U.S.
Right.
Because people thought it was safer.
And the scale of this shift is pretty amazing. U.S. Treasury gold holdings almost tripled between 1930 and 1940.
Wow.
So really the key takeaway here is that this act marked the end of relative price stability that you saw in the U.S. in the 19th century.
Right.
The U.S. dollar starts this long-term decline in purchasing power. And this trend accelerates after 1971 when the last vestige of that dollar's link to gold was severed.
This brings us to President Nixon's speech in 1971, August 15th, 1971, when he announced this temporary suspension of the dollar's convertibility into gold.
Right. It's interesting to listen to his words now knowing what happened.
Yeah.
He really emphasized protecting the dollar's stability internationally and downplayed the impact this would have on everyday Americans.
He also notably avoided the word devaluation.
Right. And that temporary suspension, as
Right.
we now know, became permanent. And it signaled the end of the Bretton Woods system.
Right.
Now, just as a quick reminder for everyone, Bretton Woods was established in 1944 with these goals of creating stable exchange rates, preventing these currency devaluations, and promoting global growth.
Right. And so the U.S. dollar became the central currency for international settlements, and it was pegged to gold at a rate of $35 per ounce.
Right. And the U.S. was basically promising to back all those dollars held overseas with its gold reserves.
Yeah.
What's interesting is that the initial reaction in the gold market wasn't all that dramatic.
Yeah.
Gold was still trading below $50 an ounce at the end of 1971.
Yeah, it seems that people maybe didn't realize the long-term consequences.
Right. Exactly.
Bretton Woods was really about creating stability.
Yeah.
But it also reflected the power of the U.S. at the time.
After World War II. Yeah.
Yeah, after World War II. Even countries like Britain, who were initially hesitant, ended up ratifying the agreement because they needed the economic aid.
Right. It really was a shift in global power. And this is kind of an interesting quote to think about. Alan Greenspan said, "In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. There is no safe store of value."
Right.
I mean, it really highlights how linking a currency to a tangible asset like gold provides a kind of discipline
It does.
that you don't get otherwise.
And it's interesting to note that even before Nixon's announcement, some European currencies, like the Swiss franc, were already appreciating against the dollar.
So there were signs.
There were signs.
The Venus there.
Yeah, and so this initial weakening of the dollar after this so-called Nixon shock
Right.
wasn't, a huge collapse or anything. But the big takeaway here is that ending the dollar's convertibility to gold took away this limit on how much paper money the U.S. government could issue.
Right.
And this basically paved the way for these massive price increases we've seen since then.
So you can really see how everything we're talking about today has roots going back decades. Let's really illustrate this idea of the declining purchasing power of the dollar.
Okay.
The 19th century, we talked about how there was this relative price stability.
Right.
But after that break with gold, the price of gold explodes from $35 in 1971 to nearly $1,895 in 2011.
Wow.
And the author really argues that this massive increase in the price of gold is a much better reflection of the true rate of inflation
Than the official figures.
than what the government might tell you. And to make this even more relatable, they even talk about McDonald's menu prices.
Yeah.
Like looking at the price of a hamburger
Over the years.
can really give you a tangible sense of how the cost of living has gone up.
Right. It's a lot more concrete than just looking at these abstract inflation figures.
Right. And so the overall trend for gold has been up. But there have been periods where the price gets ahead of itself and then consolidates.
Right.
Like you see after these peaks in the 1980s and again after 2011. And these kinds of corrections are normal in any market.
And what about central banks? Central banks are huge holders of gold reserves.
Right.
And their actions can really influence prices.
Yeah.
So the 1950s and early 60s, central banks were net buyers of gold. Then in the late 60s and throughout the 70s, they started selling.
Interesting.
And that selling intensified in the late 90s and early 2000s.
So it's like they're going back and forth,
Yeah.
trying to, manage things.
Right.
But then after the global financial crisis, there was this big shift.
They switched back to buying.
Yeah, they started buying a lot of gold, and that's continued to this day.
Yeah.
It does make you wonder about their motivations.
Yeah, it does.
Why this sudden change in strategy?
Yeah, and the author of the report even points out this questionable timing of central banks selling a ton of gold below $400 an ounce.
I mean, hindsight's always 20/20, right?
Yeah.
And while we have the World Gold Council providing estimates of gold demand and supply, the exact amount of gold held by entities like the U.S. Treasury and the PBOC in China is still kind of a mystery.
Yeah, it's a bit of a black box.
Yeah, and the author of the report expresses skepticism about the gold that's officially reported to be at Fort Knox.
Yeah, so the PBOC has been buying a lot of gold.
Yeah, especially in 2023.
Yeah, 735 tons in 2023, which was a record.
Wow.
And interestingly, a lot of these purchases were done kind of under the radar.
Almost secretly.
Yeah, and in addition to that private sector, demand for gold in China has also been very strong.
Wow, so they're really stocking up.
Yeah, they are.
The author suggests that this gold buying in China is probably a strategic move in response to what they see as increasingly hostile U.S. policies. They're preparing for potential escalation, whether that's economic or geopolitical.
Yeah, they want to be prepared.
And holding gold instead of U.S. dollars gives them more financial independence.
It's about diversification
Right.
and having options.
Yeah, and it aligns with this broader geopolitical landscape
That's
that
right.
we're seeing.
Yeah, and the report suggests that other central banks and sovereign wealth funds in countries that aren't so friendly with the U.S. might be thinking the same way.
It does make you think about, individuals outside the U.S. as well who
Yeah.
might be concerned about the potential for U.S. asset freezes
Mhm.
or even a U.S. debt default down the road.
Right.
The author reminds us of that statement that Nixon made in 1971
Yeah.
about acting in the best interests of the United States.
Yeah, which implies that they're willing to take some pretty drastic measures
Yeah.
if they have to.
I mean, it might be unlikely,
Mm-hmm.
but you can't completely rule it out.
You can't rule it out.
So there's this common belief that gold prices just move in the opposite direction to the strength of the U.S. dollar.
Mm-hmm.
But the report challenges this by pointing out that for a huge portion of the world's population, especially in these emerging economies,
Right.
the price of gold has been consistently rising over time,
Yeah.
regardless of those short-term fluctuations in the dollar.
All right, so a weaker dollar might have historically been good for gold prices,
Yeah.
but in the future, gold might become less dependent on the U.S. dollar
Okay.
and even the euro.
So its price would be driven more by demand from these emerging markets.
Exactly, and maybe even from a country like Japan.
Yeah.
The report looks at the relationship between the yen-dollar exchange rate and the gold-yen price across different historical periods, and it really shows that gold can move independently of the dollar.
Yeah. And the author even describes the yen against the dollar chart as nasty looking.
Yeah, so it seems like there could be some big currency swings ahead.
The bottom line is gold has appreciated against pretty much every fiat currency around the world.
Bitcoin being a notable exception.
Right.
Maybe, depending on who you talk to.
And this ability to preserve value over time is a big argument for owning physical gold. As the author says, it might be more accurate to say that paper currencies are losing purchasing power rather than gold appreciating.
It's a good point.
Now let's look at this relationship between gold and interest rates.
Okay.
It can be pretty complex.
It can be, yeah.
The report points to something from the Kobesi letter showing that gold has really outperformed long-term U.S. Treasury bonds in the past few months.
Yeah, which is pretty unusual.
Yeah, and especially considering that a lot of people are predicting this soft landing for the U.S. economy.
Right. Usually gold and bonds move together. So the fact that gold is going up while bonds are going down suggests something else is going on.
Right.
We saw something similar happen in the 70s after Nixon decoupled the dollar from gold.
Right.
Gold prices went up even though interest rates were rising.
And to understand this, we need to look at real interest rates.
Yeah, real interest rates, which are the nominal interest rates adjusted for inflation.
Right.
So for most of the 1970s, real interest rates in the U.S. were negative. And that coincided with a big bull market in gold.
Okay, so you see this correlation there. And then when real interest rates turned positive in the 80s, gold corrected.
It did.
So if we look at the recent increase in gold prices, the report argues that it means real interest rates in the U.S. are probably negative right now, and that the Fed might not actually be able to raise them much higher.
Even though they're saying they're going to fight inflation.
Right.
Yeah.
And this fits with what other economists are saying, like E.J. Antoni. He pointed out last year that while retail sales numbers looked good when you adjust for inflation, real retail sales were actually down.
So people are spending more but getting less.
Exactly. And the Wall Street Journal did a study on the cost of groceries. And their findings suggested that inflation is higher than the official CPI numbers.
Right. So these official numbers might not be telling the whole story.
And then on top of all of this, we're seeing this big jump in industrial commodity prices.
And this is being driven by sanctions on Russian metals.
Right. And even agricultural commodities are looking like they might break out soon. And, this recent $95 billion aid package for Ukraine, Israel, and Taiwan, that's probably contributing to higher prices as well.
Yeah, because of the ongoing conflict.
Right, and it's adding to the U.S. fiscal deficit and the overall debt burden.
It is.
Copper prices specifically are up quite a bit since their low back in February.
Yeah, they're up 21%.
Tom McClellan sees copper as a leading indicator of inflation.
Interesting.
So he's saying inflation is going to keep rising.
For at least a couple more months.
Right, or at least a couple more months.
Yeah. And the author acknowledges that there could be some speculative trading happening in China.
Right, and it is interesting to note that the Shanghai Stock Exchange has actually put in trading limits on gold and copper futures.
Oh, wow.
Maybe that's a response to this price volatility.
Yeah, trying to cool things down a bit.
But beyond inflation, this rise in industrial commodity prices could also mean that global industrial production is picking up. There were reports from Bloomberg back in April and data from JP Morgan and S&P Global that seemed to support this.
But how sustainable is this upturn?
Yeah, the report expresses some doubts.
Especially with these high interest rates, burdening government finances.
Yeah, in the U.S. and in Japan.
Yeah. Michael Hartnett from Bank of America has been really worried about U.S. government spending and the rising national debt, which hit $35 trillion in May.
Oh, wow.
And is projected to reach $40 trillion by the end of next year.
It's kind of mind-boggling.
Yeah, and he's also concerned about these increasing interest payments on that debt.
And the U.S. Treasury is issuing more short-term T-bills, which makes them more sensitive to changes in short-term interest rates.
Right, so it's like they're incentivizing the Fed to keep rates low.
Yeah.
So Hartnett has actually made some projections about future interest payments.
Yeah.
Under different interest rate scenarios.
And it really does make you think.
Yeah, the report makes this interesting analogy to corporate treasury management. Companies tend to favor short-term debt when they think rates are going to go down.
Okay.
And longer-term debt when they think rates are going to rise.
Makes sense.
And the report references Sidney Homer's work on interest rate history here.
So thinking about the Treasury,
Yeah.
maybe Janet Yellen thought inflation was going to be transitory and that interest rates would come down.
Right, and that's why they shifted to issuing more short-term debt.
And it's pretty wild to think about how financial conditions right now, according to the Chicago Fed's index, are looser than they were at the beginning of 2022.
When rates were near zero
Yeah.
and inflation was supposed to be transitory.
Yeah, there's been a lot of change, but also a lot of things that haven't changed.
Yeah.
Ambrose Evans Pritchard wrote this article in The Telegraph with the headline, "Gold is Sniffing Out Monetary and Geopolitical Dystopia."
Oh, wow.
I mean, that kind of sums things up pretty well.
It does.
He's talking about this dilemma the Fed is facing.
Right. Trying to fight inflation while also facing these risks of a funding crisis in the U.S. and all this instability in real estate and banking.
And it could all lead back to more QD.
Yeah, so it seems like the gold market is saying that a U.S. funding crisis is coming, which would lead to more money printing by the Fed.
Yeah. And dollar devaluation.
Now let's talk about the author's personal investment views.
Okay.
They see all this speculative activity across different asset classes, and they blame it on years of low interest rates and quantitative easing.
Makes sense.
And this difficulty young people are having affording housing.
Right.
It's created this get-rich-quick mentality
Yeah.
that they don't think is going to end well.
Yeah, I can see that.
So because of all this uncertainty, their strategy is to hold a lot of their assets in cash, specifically gold.
As insurance.
Yeah.
Interesting.
And they view gold and silver and platinum as the only truly honest currencies because they've held their purchasing power over time. And they've increased their own allocation to gold to 25% of their total assets.
Wow.
It's significant.
Yeah, it is.
What the author finds interesting is that investors are still really underweight precious metals, especially institutional investors.
Yeah, they're not really showing much interest.
Yep.
About 75% of fund managers have almost no allocation to gold.
Less than 1% of their assets.
And you see the same thing with gold ETFs.
Yeah, they're not very popular.
Lawrence Lepard estimates that gold and gold miners make up about 2% of total global assets right now.
Wow.
And at the peak of previous bull markets, that number was 20% to 30%.
There's a lot of room to grow.
Yeah, maybe it won't get back to those levels.
Yeah.
But the author thinks a move up to around 10% is possible.
Interesting.
Especially considering that central banks have been reducing their gold holdings.
Relative to their total reserves.
Right.
So the author is recommending some caution in the short term, though.
Okay.
They think gold and silver are a bit overbought right now.
So they're expecting a correction.
Yeah, maybe down to $2,100 or $2,200 for gold.
But they have been buying some mining company stocks.
Okay.
Along with their physical gold and silver.
Yeah, it's good to have a mix.
Tavi Costa from Crescat Capital has made this interesting observation that money market funds are at historically low levels compared to the stock market.
Mm.
So this idea that there's all this cash on the sidelines waiting
Right.
to come back into the market.
Might not be true.
Yeah.
So if the stock market crashes,
Yeah.
people might want to move into precious metals.
Especially if the Fed cuts rates and the dollar weakens.
Right.
So the takeaway here is that while other assets might have higher returns
Yeah.
in the long run,
Mm-hmm.
gold is a safe haven,
Right.
especially in these uncertain times.
Now, the report also touches on the value versus growth debate,
Mm-hmm.
and it references an article the author wrote back in 2020, 2021,
Yeah.
where they predicted that the outperformance of growth stocks was ending.
Okay.
At the time, growth stocks were so much more expensive than value stocks.
Mm-hmm.
Whether you looked at price to earnings,
Yeah.
or price to book, or price to sales,
Right.
and they also had a lower dividend yield.
And historically, value stocks have done better over the long term?
Yeah, over the very long term. We have seen these periods where growth outperforms.
Yeah, like in the late 80s and 90s,
Yeah.
and then again from 2007 to 2020.
Right. But then value had that big run after the dot-com bubble.
Yeah.
And since the author's 2021 article,
Mm.
value and growth have actually had the same returns.
Wow. So it's interesting how things shift back and forth.
Yeah, and right now value stocks are still a lot cheaper than growth stocks.
Yeah.
So it seems likely that value will do better going forward.
And the report points to some specific areas within value that look really undervalued.
Like the dogs of the world.
Yeah, these emerging markets,
Mhm.
like Brazil and China.
In Italy, Malaysia, and Spain.
Right.
They're all trading at a discount to the S&P 500.
And platinum also looks really cheap compared to gold.
Yeah, that's another interesting one to watch.
The report ends with this warning from Paul Volcker back in 2018
Mm-hmm.
about the dangers of inflation and speculation.
Yeah, all this easy money.
Right, and he emphasized the central bank's responsibility to keep things stable.
Yeah.
And the author thinks that any weakness in these big tech stocks
Mhm.
could benefit global value stocks. So it's like a rotation out of U.S. tech,
Yeah.
including AI,
Mm-hmm.
and into things like mining.
And emerging markets and energy.
So to summarize for everyone listening,
Mm-hmm.
we've gone through the history of gold
Yeah.
and how the abandonment of the gold standard has impacted its price.
We've talked about inflation
Yeah.
and real interest rates.
And the actions of central banks
Mm.
and these future drivers of gold demand
Yeah, all these geopolitical factors.
and the debasement of currencies.
Yeah, the author sees gold as a kind of insurance
Mhm.
to protect your purchasing power
Right.
in a world full of uncertainty.
And we want to leave you with this thought.
Mm-hmm.
How are you thinking about your own portfolio?
In light of all of this,
Yeah.
what does the concept of honest money mean to you?
It's something to think about.
It is, and maybe Ron Paul's quote kind of sums it up.
Mm-hmm.
He said, "Because gold is honest money, it is disliked by dishonest men."
That's a good one.
Yeah, it really makes you think
It does.
about, what's going on in the world today
Yeah.
and what the future holds.
Absolutely.
Thanks for joining us for this deep dive.